Welcome back to our special show on the Indian rupee. Still with us are Sajjid Chinoy of JPMorgan and Deepali Bhargava, the economist from Credit Suisse. Well, Deepali, you know, exports is one part of the story, but a strong Indian rupee, especially appreciating 10% vis-a-vis China, would also mean cheaper import onslaught for commodities like steel. Do you think that this can meaningfully harm Indian domestic industries as well, the strong rupee?
Right. I mean, the first point that I would like to make, there is there has generally been a decline in import intensity for India. I mean, just if you look at the total imports by GDP, it's been coming down since 2012. I mean, partly because in the last 1 year, coal has come down. Coal imports have come down compared to coal production. Gold imports, positive real rates has impacted reasonably. But even barring coal and gold, your overall, intensity for imports has come down.
Yes.
So you have to look at it in that perspective when you really talk about how destructive it could be for the industry as a whole.
Fair enough. I still worry about steel, perhaps. But a final question to you. What tools does the RBI have? Even if, okay, well, let me put this first to Sajjid. Sajjid, since November 8th, the rupee has strengthened even on days when the dollar has strengthened. So, do you expect this to continue? And what's your sense the Reserve Bank can do?
Well, we need to be careful here. I think the rupee has broadly performed, forget about the last week where we've outperformed. If you look at any 3 or 6 month period, and if you compare the rupee to how other emerging markets have performed, we've been broadly in the middle of that pack. Start from January of this year to March 15th, we're maybe in the top 40%. Go back to last year, we're in the top 40-50%. So directionally, we have performed in line with other emerging markets. So you may find a situation where the dollar strengthens against the G7 or the G10, but EM still rally like they have been in the last couple of months, and then the rupee, yes, will appreciate. So I don't think we will directionally go against where emerging markets go.
Okay, well, finally, Deepali, what about the Reserve Bank's options? Does it have the wherewithal to prevent the appreciation? Or do you think it will run counter to its anti-inflation stance?
Right. I think they will, like I said, they will let the dust settle for a bit, because it does seem like it's pretty much event related, and we'll probably have more clarity later during the day. I think it's very unlikely. I would tend to think that it's just unidirectional, given the way the global scenario is. There are a lot of factors which are going to play out for G3 and for the dollar G3 pair, which are likely to impact EM currencies as a whole. So it's difficult to see. I think probably we'll be stuck in ranges in a way, rather than trending very meaningfully, and hence I think it's difficult to see that sharp appreciation in the near term.
All right, that's good to hear. Sajjid and Deepali, thank you very much for joining us. Deepali at least doesn't see too strong or a unidirectional appreciation of the currency. It's important to note that appreciation hurts. Imports become cheaper, and more importantly, Indian exports, especially IT exports, could have a problem. And today you could see the hurt in IT stocks. Those companies were the top losers in the Nifty today. TCS, Infosys ending over 2% lower. Reema Tendulkar is here to give us some analysis on how the dollar weakness or the rupee strength can hurt IT companies. Reema.
Hi, thanks so much for that. Well, I'm reading out an MK note which said that if the current rates which we have today prevail till the end of the month, then the average of the rupee dollar in this quarter will be about 1.5% higher than what we had in the prior quarter. And roughly or theoretically, a 1% rupee appreciation is negative to the margins to the tune of 20 to 25 basis points. So assuming a 1.5% appreciation, we are talking about a margin hit of 30 to 40 basis points for the IT companies. So the earnings impact could flow down, which could be to the tune of about 1 to 1.5%. So what MK says is that this could be a sentiment negative for the offshore Indian IT companies, especially at a time when they're battling with a negative sentiment on account of the adverse visa regulation. They also go on to say that the rupee appreciation is a bigger threat to the tier 2 IT companies over tier 1 because A, they have a lower margin profile, and secondly, their sensitivity is a lot higher. So they'll watch the tier 2 IT stocks a little more closely. Back to you.
All right, thanks a lot for that, Reema. Well, that's the story of the resilient rupee, but the one big event that could impact the rupee's movement is the two-day Federal Reserve meet that ends tonight. Investors around the world are expecting the Federal Reserve to increase rates tonight, fueled by, of course, strong jobs data. What will be interesting is to see the Fed's dot plot. That charts the number of rate hikes that the Fed governors themselves expect. CNBC's Steve Leisman polled about 50 economists, fund managers and strategists and filed this report on the results of the CNBC Fed survey. Hear him out.
At the beginning of 2016, the Fed forecast 4 rate increases. It ended up hiking just once. Now it's projecting 3 rate hikes, and the question is the forecast any better this time? And the answer may be maybe. One difference between now and then, the market this time actually believes the Fed. The CNBC Fed survey shows 60% of respondents think the Fed will hike 3 times in 2017. Another 25% think there could be as many as 4 rate hikes. And rather than fighting the markets, this time the Fed will just be going along with what the market already believes. All of the survey's 50 respondents, who include economists, money managers, and strategists, think the Fed will hike at its March meeting, and most see another rate hike coming again in June. Survey respondents are generally upbeat about the president's economic agenda, giving high marks to deregulation and tax cuts for businesses and individuals. But they seriously dislike what they hear of the president's trade agenda. Most think the controversial border adjustment tax is negative for economic growth. Meanwhile, 64% think the stock market is too optimistic about the president's agenda. They've marked up their growth forecast by just 0.2% for 2017 and 0.4% for 2018. That's a far cry from the 1 or 2 full percentage points that the administration thinks its reforms can deliver.
That's it on our special show, The Resilient Rupee. Do stay tuned in. More news and views follow.